If you are retired or within 5 years of retirement, pause whatever else is happening in your day and listen closely, because the ground under your savings just shifted. The headlines call it a deficit reduction plan. The lawmakers call it closing loopholes and modernizing retirement policy. But the way it is constructed, the effect lands squarely on people like you who did everything right, saved in tax-advantaged accounts, delayed gratification, planned for dignity and independence, and now find yourselves in the crosshairs of a tax regime that is quietly, methodically extracting more from the nest eggs you depend on. I'm going to walk you through what changed, why it changed, and how the ripple effects are setting off alarms across bond desks, wealth management offices, and yes, inside central banks that are loading up on gold at a pace we haven't seen in generations. Stay with me, because what looks like policy minutiae is actually a coded message about where the people in power think the value of money is headed next. First, let's decode the mechanics. The headline changes are subtle, almost surgical. Distribution thresholds from tax-deferred accounts now phase in surtaxes sooner than most planning models assumed. The brackets themselves get their usual inflation update. But in an era where official inflation and lived inflation don't match, a modest bracket adjustment is a stealth tax increase. The sequences that trigger Social Security benefit taxation remain stubbornly tied to thresholds that haven't kept up with real costs, so more of your benefits can become taxable as your required minimum distributions grow. On top of that, limits around certain Roth conversion strategies tighten, especially for higher balance accounts, and deductions phased out for those who, in Washington's new language, enjoy disproportionate tax benefits relative to income. That phrase tests well in press releases. In the real world, it means the retirees who save diligently are the easiest pockets to tap. Imagine Elaine, 64, in her final year of work. She and her partner did everything by the book, maxed their 401ks, paid off the house, set a conservative withdrawal rate. Their planner had modeled a path where their RMDS wouldn't push them above a certain bracket until age 75, at which point charitable gifts would offset some of the tax hit and Roth conversions would smooth the curve. The new law compresses that time horizon. The bracket glide path steepens, not because Elaine suddenly became wealthy, but because the definitions of income and phase-in were recalibrated to capture more of the distributions, especially unhedged, tax-deferred growth that swells nominally when inflation lingers. The tax code, like a tide coming in, finds your feet before you even notice the water creeping up your ankles. Why now? The answer lives where budgets meet politics. Debt service costs have surged with higher interest rates. The arithmetic is brutal. Every extra point in interest across tens of trillions requires fresh revenue or fresh borrowing. Taxing current workers is unpopular. Taxing corporations triggers lobbyist wars. But tightening retirement rules can be sold as fairness, anti-abuse, or necessary modernization. The unfortunate truth is that retirees are a captive market. You can't just not retire. Distributions will happen. The government knows when they will happen. And the machine can harvest more sooner, with little risk of revolt because the changes look technical rather than punitive. Now layer that over the investment landscape retirees face. Yields finally look alive after a decade of starvation. But the price of those yields is volatility and duration risk many can't stomach. Equities levitate with a handful of mega-cap leaders while breadth thins and earnings are increasingly dependent on cost-cutting, buybacks, and AI optimism that may take longer than advertised to monetize across the broader economy. Meanwhile, the cost of living experienced by retirees, healthcare, insurance, property taxes, travel, utilities, floats higher on currents that don't reverse simply because a policy rate ticks down 0.5%. The question is not whether you should earn a return. Of course you should. The question is what portion of your savings should be insulated from the tax law roulette and currency debasement creep that seems baked into the next decade. This is where the behavior of institutions becomes the story within the story. Central banks have been buying gold at a rate that recalls the 1960s and 1970s. Over the past couple of years, annual net central bank purchases have hovered around 1,000 metric tons, a record pace in the modern era. Not just the usual suspects either. You have reserve managers in markets that used to be dollar-only shops now diversifying, quietly, methodically. Why? Because they too read the math on debt service. They too understand that fiscal repair via real austerity is politically suicidal, and that inflation is the more palatable tax, invisible, broad-based, denial-friendly. Gold is not a religion to them. It is a hedge against the policies that the debt forces democracies to choose. Before we go deeper, let's talk about price action because it tells you how the crowd is voting with capital, not opinions. Over the last few years, gold carved out a series of higher lows while attacking overhead resistance near prior peaks, stubbornly refusing to break down with each dollar rally or rate spike. Each pullback into the low 2000s and 30s has drawn in dip buyers. Momentum oscillators cooled without cracking the long-term uptrend. The 200-day moving average crept higher, acting as a rising floor. On breakouts above the old range highs, you saw participation broaden. Miners waking up, silver tagging along, and physical premiums firming in certain retail channels before wholesale markets fully adjusted. That pattern, foundation building before sustained advance, is classic of accumulation driven by larger hands who care more about tonnage than ticks. But technicals are only half the story. Supply is less elastic than most imagine. Mine production has plateaued, grades are lower, permitting takes longer, and capital discipline, after the sins of the last cycle, remains tight. All-in sustaining costs have marched higher with energy, labor, and regulatory burdens. New discoveries that move the needle are rare, and developing a large project is a decade-long proposition. Recycling supply helps, but it tends to be procyclical and limited by consumer behavior. On the demand side, remember that gold is both an investment and a quasi-monetary reserve. Jewelry demand shifts with incomes in Asia and the Middle East. Investment demand surges not only with fear, but with policy incentives. ETF flows swing with risk appetite. Bar and coin demand responds to policy whispers and banking stress. Official sector accumulation responds to sanctions risk, reserve diversification, and currency politics. Speaking of politics, look at the map. Sanctions have turned access to reserves into a geopolitical weapon. If you are a country that thinks you could someday land crosswise with US or European foreign policy, you learn a simple lesson. Keep a portion of reserves in an asset that sits outside another country's banking system. That asset has no counterparty. That asset can be flown if it must. That asset is gold. Now tie that behavior to trade patterns, the rise of bilateral settlement, chatter about BRICS currency experiments, and the growth of non-dollar trade flows. None of these dethrone the dollar next Tuesday, but they channel incremental demand into an asset base that is not growing quickly. The marginal buyer is persistent, patient, and price-insensitive because their objective is insurance, not yield. Let's bring it back to retirees and taxes because this is where the signal gets clearest. When lawmakers broaden the definition of taxable base for distributions, tighten conversion pathways, and leave benefit taxation thresholds under-indexed, they are telegraphing that private retirement capital will be asked to shoulder more of the fiscal burden. You'll see it not only in the headline rates, but in the interaction effects. RMDs nudging you into a surtax bracket, which then triggers a higher Medicare premium tier, which then increases the marginal tax on the next dollar of distribution. It's the retirement tax torpedo. Except now the torpedo's guidance system got smarter. Planners will adjust. You'll adjust. But what if a portion of your wealth simply lived outside the moving parts of that formula, not evading tax, but strategically sheltered from the policy noise that erodes purchasing power and compresses after-tax returns? Some will say, but gold doesn't yield. True. Gold is not a bond, not a business, not a rental property. It's a store of value that speaks a language older than spreadsheets. In a world where yield is a promise that depends on policy, gold is an asset that does not need anyone's permission to be what it is. And in tax-deferred or tax-advantaged accounts specifically designed to accommodate physical precious metals, you can own that stability without incurring immediate collectibles tax treatment on appreciation. The key is using the right structure, approved custodians, approved bullion types, and clean separation from personal possession to satisfy the letter of the law while achieving the spirit of preservation. You can see how institutions approach the same problem. Look at ETF flows. When risk appetite fades, paper gold sees inflows. When the equity rally sprints ahead, ETFs may bleed even as central banks continue to accumulate. The divergence tells you who buys for trade and who buys for regime insurance. Futures market positioning reveals a similar push-pull. Managed money piles in on momentum. Commercials hedge and arbitrage. The critical detail is not the weekly swings, but the inventory in the vaults backing the system. Registered bars, the portion available to meet delivery obligations, fluctuate. In tight periods, the ratio of open interest to registered ounces stretches, and the market responds by adjusting incentives, widening spreads, or sourcing metal. It's the paper versus physical tension that gives gold its unique heartbeat, a financialized asset whose ultimate settlement lives in a vault, not a spreadsheet. Now, the history that matters. In 1971, when convertibility ended and the last thread of the Bretton Woods fabric was cut, there was confusion first, then volatility, then a repricing of reality. The 1970s told a brutal story: oil shocks, fiscal deficits, and a populace learning that inflation is a tax nobody voted for. Gold didn't respond linearly. It surged, consolidated, and then surged again as confidence in policy eroded. By 1980, with rates driven into the teens, the message was clear: you can slay inflation, but only with pain steep enough to cost elections. Fast forward to 2008, a crisis born in leverage and opacity. Gold responded not just to fear, but to the medicine, quantitative easing, that would define a decade. In 2011, as the Eurozone shuddered, gold kissed the then all-time highs, then spent years digesting the binge. In 2020, a pandemic shock reintroduced the world to supply chains as a fragile miracle. Gold ran as the money printer met lockdowns and uncertainty. Each episode rhymes. Policy conjures unintended consequences. Gold translates them into a price where trust and math intersect. What about now? The new tax law is not an isolated event. It's a symptom. It tells you that the path of least resistance for governments confronting unpayable promises is not sudden default, but incremental redefinition of what counts as taxable, of what counts as wealth, of how quickly the government can put its straw into your savings. Pair that with deficits that stubbornly refuse to shrink during expansions, and you get a structural bias toward inflationary finance. Even if official inflation cools in a given quarter, the deeper rhythm, a currency supply growing faster than productive capacity, pushes value toward wells that don't rely on someone's willingness to roll your loan. That's why gold's long-term chart looks like a staircase to people who zoom out. A brief detour into the plumbing. London's over-the-counter market clears enormous volumes daily, a ledger of transfers among banks, dealers, and clients. Much of that is unallocated, claims to metal rather than earmarked bars. It's efficient, liquid, and opaque by design. The COMEX futures market is where price discovery visibly happens to the public eye, a carnival of leverage managed by a small community of professionals who arbitrage basis, hedge mining exposure, and warehouse risk. The Shanghai Gold Exchange asserts a growing role in price formation, especially during Asian hours, with contracts more oriented toward physical settlement. These venues don't compete so much as they coexist. When tensions arise, premiums opening between regions, tightness in a specific bar standard, or seasonal surges around festivals, you see the global machine redirect flows. Arbitrage closes gaps. But if stress becomes structural, and the bids from official buyers don't care about basis points, the machine groans. The signal is not a headline. It's the stubbornness of premiums and the unwillingness of metal to move out of strong hands. All of which brings us back to you, the retiree, staring down a code that got more aggressive just as the cost of living refused to behave. What matters most is your real, after-tax, after-inflation purchasing power. You're not playing to beat an index anymore. You're playing to fund a life. Dinners with your family, trips with your grandkids, the freedom to say no to compromises that insult the dignity you spent decades earning. In that pursuit, think of gold not as a speculation but as the keel of your ship. It doesn't make you fly across the waves. It keeps you from capsizing when the wind shifts and the policy tide surprises you again. Quick aside, because this is timely and practical. If you're sitting on $100,000 or more in retirement accounts and you've wondered how a gold IRA actually works, I put together a straightforward free guide that walks through the process. It explains which types of bullion are eligible, how custodians and depositories work, and the rollover steps to avoid triggering taxes or penalties. It's linked in the description. If protecting a slice of your savings from policy whiplash is on your mind, it's worth a look. Now, let's get back to where the metal itself is signaling we might be headed. Consider the path from here in scenarios, not predictions. If inflation proves sticky and rate cuts limp along slower than markets crave, real yields wobble, and the patience of equity investors gets tested. In that environment, gold does not need a crisis to do its job. It benefits from the slow bleed of confidence as people decide they want a chunk of their wealth outside the narrative machine. If growth weakens and the policy response leans dovish, gold catches the tailwind of lower real yields, and the prospect that negative carry, already muted, matters less than the fact it does not carry default risk. If we get a shock, geopolitical, banking, cyber, take your pick, the bid for insurance becomes loud, and the scramble from paper to physical lifts premiums first, then price. Technically, watch the way pullbacks behave. In healthy advances, the metal consolidates in time more than price, drifting sideways while moving averages curl beneath it. The dips are bought before they tag the obvious levels. When the pullback is deeper, the response at prior breakout zones becomes a tell. Do buyers defend those areas decisively, or do we churn? Volume on the rallies versus the declines matters. Even in OTC-dominated markets, you can read the enthusiasm in the vehicles we can see. Likewise, keep an eye on the miners. They are not gold. They are businesses with cost structures, jurisdiction risks, and capital allocation choices. But when they start to outperform the metal, it often signals that investors are not just hedging, they're reaching for leverage to the theme. There's a psychological piece to this that's hard to quantify and impossible to ignore. Retirees are, by necessity, planners. You learn to believe in schedules, budgets, predictable outcomes. The last few years have punished that temperament, not because it's wrong, but because the environment is disorderly by design. Policymakers discovered that uncertainty is a policy tool. Adjustments happen late at night, on weekends, after quiet leaks, and behind jargon that discourages scrutiny. Markets respond with violent bursts of relief and fear that don't match your life's cadence. Owning gold does not fix that noise, but it shifts your relationship to it. It turns you from a passenger, reacting, into a person who owns something that behaves like silence when the band gets too loud. Let's widen the lens to long cycles. Demographics pressure entitlements. Technology reshapes productivity but also shifts income shares. Geopolitical multipolarity complicates trade and finance. In that stew, a country with deep capital markets and global trust can lean on its currency privilege longer than the skeptics think. But the price of using that privilege too aggressively is that others plan around you. They carve out alternatives. They hold more of what you cannot sanction. They diversify the base of their savings into metal and commodities and bilateral IOUs. None of that ends in catastrophe for you tomorrow. It does, however, create a quietly rising floor under the price of assets that exist outside the system's promises. You might ask, what about taxes on gold itself? Fair question. In a taxable account, the U.S. treats long-term gains on certain forms of gold as collectibles with a higher maximum rate than typical long-term capital gains. That's a reason many investors who want a core allocation house, the position inside tax-advantaged structures where permitted, or use vehicles that align better with their tax strategy. The point isn't to dodge the rules, it's to obey them intelligently. The very existence of these rules, detailed, fussy, and evolving, should tell you something else. Gold matters enough to the system that the system wants to define it carefully. Things the system can't ignore tend to be useful to individuals. Silver always comes up in this conversation. It rides shotgun with gold, but with a turbocharger. Industrial demand for silver, in electronics, solar, medical applications, overlays the monetary demand. That makes it twitchier. Some retirees prefer a steadier keel. Others allocate a smaller slice to silver precisely for its torque in certain environments. Just remember that liquidity and storage considerations differ. And if you're working within retirement account rules, the list of acceptable products and custodianship details deserve careful attention. Let's revisit the retiree's tax shift from a different angle. Incentives. When the code nudges you toward taking distributions sooner or in larger amounts, it changes the path of your taxable income. That, in turn, changes how you invest. If your after-tax return expectations compress, you may be tempted to reach for risk to make up the difference. That's where personal disaster often begins. The wrong deal, the wrong product, the wrong promise pitched by someone who profits whether you do or not.